Welcome to Group 4's presentation. We'll be having a look at Cooper Energy. Let's get straight into it. The name comes from their origins in Australia's Cooper Basin, most of which lies in Queensland, some of it in South Australia. They have offices in Perth and Adelaide. Cooper Energy discovers, commercializes, and sells gas in Australia. Their logo has two colors. Green represents gas and red represents oil. These two colors come together in a helix shape, which, a lot like the human DNA, tells us that oil and gas are the fundamentals of Cooper Energy's revenue. Of the two, gas dominates its earnings. It's listed on the S&P 500 index in the US and on the ASX in Australia. A closer look at their assets shows us an onshore and offshore site in the Otway Basin, an onshore basin in Gippsland, and the Cooper onshore basin. Onshore basins are drilled at land, whilst offshore basins drill at sea. They were not profitable in 2019. However, 2020 Q4 revenues of 24.1 million Australian dollars are 61% quarter on quarter up from 2019. Three cheers for their shareholders. Their CSR initiatives and activities can be broadly looked at under two buckets. One being people and staff related, the other being environment related. They seem to be focusing on the former. They boast an above industry average female composition of workforce. They've associated with the universities of Melbourne and Adelaide in various capacities. They've also accepted over half of their sponsorship requests, worth about $90,000. On the environment front, they have a robust risk management program, which has yielded zero injuries and mishaps at work, which is always great to see. They use scenario modeling to mitigate climate change and are very proud of their deep ties and connects with the marine industry.
Thanks, Akshat. This is Yanlin. Cooper Energy's CSR report is prepared in line with the principles of the Global Reporting Initiative (GRI) framework. The reporting principles of GRI for defining report quality are accuracy, balance, clarity, comparability, reliability, and timeliness. To be specific, accuracy means that the information reported on the sustainability report should be sufficiently accurate and detailed. Balance means that both positive and negative aspects of the reporting organization's performance should be reported. The third principle is clarity. In other words, the report should be understandable to stakeholders. The fourth one is comparability. The reported information should be presented in a manner that enables stakeholders to compare the organization's performance over time and relative to other organizations. The requirement of reliability is that the organization should ensure the quality and materiality of the reporting information. The final principle is timeliness. It is necessary for a reporting organization to report on a regular schedule to ensure information is available in time for stakeholders. Then let's welcome Jia to introduce the first paper.
Thank you, Yanlin. I'm Jia. Now I will talk about the literature review related with the paper 1, the effect of mandatory CSR disclosure on firm profitability and social externalities, evidence from China, written by Chen et al. In this paper, the authors propose two hypotheses. The first one is firms experience a decrease in performance subsequent to the mandatory CSR disclosure. Firm performance is measured using ROA or ROE. The second one is cities experience a decrease in pollution after the mandate. The pollution is reflected by industrial wastewater and sulfur dioxide emission levels. The results of the regression analysis are consistent with the author's hypothesis. With the help of additional analysis, the authors make some important conclusions. Firstly, total CSR spending, especially increasing environmental protection spending, is associated with decreases in firm profitability and pollution, which means that mandatory CSR disclosure changes firm behavior and generates positive externalities to society at the expense of shareholders. Besides, state-owned enterprises' CSR spending is less efficient than that of other firms. Lastly, the mandatory CSR reporting firms have fewer workplace fatalities. Now, let's try to verify these conclusions. Before we apply these conclusions to Cooper Energy, some points need to be noted. In Australia, sustainability reporting is voluntary, and Cooper Energy is not a state-owned enterprise. Therefore, some conclusions from the paper may not apply to Cooper Energy. We tend to study whether Cooper Energy could do better if CSR disclosure is mandatory. At first, we can say that Cooper Energy has excellent safety performance, although the working hours increased compared with 2018. The number of incidents has dropped. There are 0 lost time incidents and a total recordable case frequency rate of 0. This implies that Cooper Energy focuses on staff protection, which is a critical dimension of CSR. In terms of environmental protection, Cooper Energy's greenhouse gas emissions show a clear downward trend, and it completed the year with 0 reportable environmental incidents. Although Cooper Energy has carried out a number of CSR initiatives, its performance has not been affected. However, CSR spending related with these initiatives cannot be found in the CSR report. In conclusion, Cooper Energy has strong CSR performance, especially in terms of employee safety and environmental protection. However, the CSR spending related to this is not disclosed in the CSR report. Therefore, mandatory CSR disclosure could help Cooper Energy do better, which makes CSR-related expense more transparent and help investors to understand relevant information. Now, my teammate Akshat will introduce the next paper.
Paper 2 is titled CSR Needs CPR, Corporate Sustainability in Politics. Liang et al.'s 2018 paper is a vociferous critique of existing CSR reporting requirements. The focus is on how political activities like lobbying can far outweigh a company's CSR initiatives. We're given a definition for CPR and 9 pillars therein, relating to lobbying, astroturf lobbying, and even working a bit too close with the government. This concern resonates with senior representatives of Australia's superfund industry as well. In recent news, they've called out companies whose lobbying activities contradict CSR initiatives. They've even said such companies will attract more scrutiny. But the authors, they're optimistic about the future. They say millennials will exact more transparency from products we consume, employers that they work for, and companies they invest in. With regards to CPR, we're given positive and negative examples of companies like Nike and BP respectively. We're also given some positive developments in CPR as a discipline. The paper does, however, acknowledge that this won't be easy and that a framework for CPR is probably further down the road. However, the authors do stress that hypocritical lobbying and dark money are evils that we should deal with sooner rather than later. Let's apply this paper to Cooper Energy. Now, firstly, the paper gives us the example of the UN Global Compact. This is the world's largest corporate sustainability initiative. 2 Australian energy companies are active members. Cooper Energy is not one of them. Now, whilst we can control for many factors, their share prices are much better than Cooper Energy's. Cooper Energy can thus consider getting involved. Secondly, the paper highlights the need for transparency. Cooper Energy's sponsorship requests worth about 87,000 Australian dollars are spread across 3 themes: education, health, and sustainability. But we're not given a breakup. Stakeholders would like to know how much of the sponsorship was towards sustainability. Cooper Energy can do better in this regard. Lastly, Cooper Energy's CSR report highlights positive future prospects. more demand than supply. A cursory Google News search reveals news of new projects, new joint ventures, they're even hiring new staff. Clearly, there is growth. And whilst that's good news for some shareholders, others would like to know if this growth is met with a commensurate rise in CSR initiatives. As it turns out, Cooper Energy has indicated a planned adoption of the GRI framework for sustainability reporting. Now, Delma et al.'s paper highlights a new standard 415 in this very GRI framework. This new standard 415 talks all about public policy disclosures, which will perhaps explain Cooper Energy's stance with regards to their lobbying activities. Thus, the wait for their new report is a very exciting one.
Hi, I'm Liang Weiwen. Now we are going to review voluntary non-financial disclosure and the cost of equity capital, the initiation of corporate social responsibility reporting. This paper is investigating the impact of standalone voluntary disclosure of general CSR issues on the cost of equity capital. These researchers have analyzed 213 standalone CSR initiating firms across 23 industries from 1993 to 2007. And it comes to two major hypotheses. Hypothesis 1, when ERT cost of equity capital increases by 1 percentage point, the probability of initiating standalone CSR disclosure in year 2 increases by 1.02%. Hypothesis 2, CSR disclosing firms with superior CSR performance achieve a reduction as 1.77% in their cost of equity capital. But this may not be the case for CSR disclosing firms with subpar CSR performance. It also comes to some other insights. The first one, CSR initiating firms with super CSR performance benefit from better analyst coverage and dedicated institutional investors. Furthermore, CSR initiating firms are more likely to issue SEO or secondary issue after their IPO. Further, these firms are likely to raise significantly larger amounts of equity capital than non-initiating firms. The research considers only standalone CSR disclosure initiating firms. Standalone CSR disclosure brings better depth and coverage. However, in doing so, it only adopts KLD scores as a qualitative measure of CSR and does not conduct an independent study of CSR reports of firms in the sample. In light of this, the paper opens up avenues for further study in the correlation between CSR disclosure, CSR performance, and financial performance, especially cost of capital. We have analyzed the data of Cooper Energy in 2018 ST and 2019 ST plus 1 based on hypothesis 2. We control the variables beta, leverage, and the market to book ratio. The result of the percentage of the change of cost of capital is about 41%. Our research figures are inconsistent with the hypothetical predicts of the reduction in COC ratio, which is 1.77%. However, as a result of controlling for limited variables, Cooper Energy's cost of equity capital decreased by approximately 41%, which is in line with the assumed downward trend. This result confirms the assumption that firms with super CSR performance enjoy a reduction in the cost of equity capital if they publish standalone CSR reports. Now let's welcome Yanlin.
Thanks, Weiwen. Hello again, this is Yanlin. Cooper Energy's CSR report is consistent with the reporting principle provided by the GRI framework as a whole. First of all, the report contains table of contents, maps, and tables to present information in a concise way, which enables stakeholders to find the information they want without reasonable effort. Secondly, the information included in the report is comparable. In the health and safety part of the report, both the safety performance of 2018 and 2019 were presented so that information can be compared on a year-to-year basis. It is comparable to the industry benchmark as well. Additionally, the information in the report clearly indicates the time period to which it relates. Thus, the data in the report has been disclosed in time for stakeholders. However, there are still some weaknesses in Cooper Energy's CSR report. Cooper Energy did not describe the measures for data and basis for calculation of the female representation percentage. In other words, they did not present the number of female staff they have and total staff. Hence, it does not meet the principle of accuracy. Besides, the report covers only favorable results and topics of the organization. This is not compliant with the balance principle. Overall, in order to make some improvements, Cooper Energy should describe the measures for data and basis for calculation in their CSR report in order to increase its accuracy. Meanwhile, presenting both positive and negative results and topics in their CSR report is recommended to give stakeholders a holistic view of the company's CSR activities. This is all of our presentation. Thank you for listening.